If you want to become a Forex trader, you have to watch this video. In this video, I'll show you what the best Forex pairs are, what are the best times to trade, what are the best time frames you should be trading, what are the best trading strategies, how do you find the best trades, and I will also provide some tips on how to avoid the most common mistakes when it comes to trading psychology and also risk management. We are starting with the first very important question: what is the best time of the day that you should be trading, and what is the best Forex pair? And those go hand in hand. So there's a very handy calculator from investing.com. I'm leaving all of the links from the video in the video description below so you can check them out. And what it does is that it gives you a table with all of the Forex pairs, or at least most of the common Forex pairs. It shows you how much has the Forex pair moved on average per day in pips, but also in percentages. And I would focus on the percentages part first because this is more important. We want to find a Forex pair that is moving a lot. Only when the price is moving, then we would be able to make profits. When a pair isn't moving, there are no profits. What we would then do is we find a Forex pair with the highest or very high percentage readings, such as the Aussie yen or the Australian US dollar. And we're going to take a look at them. They have the highest potential in a day. So let's take a look first at the Aussie yen. And again, this is from investing.com, link in the video description. And what it does, it shows you the hourly volatility of the Forex pair, in this case, the Aussie yen, in terms of pips per hour. And what you can see is that here you get the breakdown per day in a 24-hour cycle. So in this case, we have GMT and I'm living in Germany. So I want to find a Forex pair that is moving when I am awake. And this is what you should be doing as well, depending on what time zone you're in. So here you can see the Aussie yen is quite active here in the night, which makes sense because it is the Asian session. And then we have a little bit of a spike here in around the New York Open, which is around 12 and 1 p.m. GMT. So this might not be ideal because it seems to have the most active time here during the night. Let's contrast this with the Aussie US dollar. And here you can see, when we take a look at the upper part, which is the 24-hour cycle, the Aussie US dollar has its most active part here around the New York Open, which is for me around 1 or 2 p.m. until 3 or 4 p.m. here my time. And this is ideal. So the Aussie US dollar is a great candidate for a Forex pair that I could be trading based on my time zone. It is moving the most here. And this is especially important if you want to trade it on the lower time frames. If you are trading on the higher time frames, which I will come back to later in this video, it doesn't make so much of a difference when it moves the most, but it's still quite helpful to understand when your Forex pairs are moving. So let's take a look at the Aussie US dollar. And here we can see why it's important to find a Forex pair that is moving. And you can see that the Aussie US dollar has very nice trending phases. Of course, there are periods where the market is just going sideways, but by and large, you can see that the Aussie US dollar has some really nice trending moves and some very clean trending phases. Contrast this with the Euro Swiss. So when we take a look at the table and we look at the Euro Swiss, which is down here, you can see it only has a 0.53% daily range or a daily move. Contrast this to the Aussie US dollar, which is twice as high. And when we take a look at the Euro Swiss now, you can see the big difference. We do have trending phases, yes, but the trends are less clean. There's a lot more volatility, there's a lot more back and forth, a lot more noise in the market. So finding a Forex pair that moves a lot and also has clean moves without too much volatility and more momentum is a really first important step that you need to do in order to improve your Forex trading and in order to find potentially good charts that you can trade with. We are going to dive into time frames, risk management, and trading psychology in a moment, but I want to first focus on where and how to trade. So what we're going to do is we're going to take a look at the broad trading categories or trading strategies. And typically we distinguish between trend following, reversal trading, range trading, and then we can also distinguish between pattern trading, which can also be summarized as price action trading, indicator trading, and fundamental trading. And in this video, and I think most of my viewers are falling into those two categories, we're going to do a trend following approach and also pattern trading or price action trading. So for a trend following approach, we want to ask, what is the current trending direction? What is the current overall trending environment, so that we can try to capitalize on the trending moves that are happening. Again, you want to find a market that is moving. That's the prerequisite number one. And also we want to analyze, is the trend that we are observing, is it slowing down or is it accelerating? Those are very important points that we come back to in a moment when we took a look at charts. And when it comes to pattern or price action trading, we want to look for patterns that we have maybe already observed, that we have seen before, that we have tested, maybe in our back test. And also we then want to ask, does the pattern fit into the right context? Is the trending context, is the overall chart context fitting to the pattern and the price action signal that we are seeing? And this is a very helpful quote here at the bottom. Price is king, but context is the emperor. Price action is important, patterns are important, candlestick signals are important. However, if the pattern, if the candlestick, whatever you're looking for, doesn't fit into the big context, into the trending environment, into the chart environment, then usually what happens is that the trades that you are finding are not optimal. And I will go through a few very important chart patterns, and I will show you not only the pattern, but the broad context. So we're focusing first on the cup and handle. It's a trend continuation. We have to keep this in mind, continuation of a trend. I will come back to this in a moment. Then the cup and handle also has breakout components, and it's a complex multi-leg pattern. So when we look at a general cup and handle, this is how typically it looks like. And the most important thing that you need to understand is that you are in an uptrend. The market is trending higher here, so you're looking for continuations. You want to look for what has the market done in the most recent history. In this case, it has been trending higher. And then we want to observe the current trending environment. What is the market doing? The market has put in here a resistance area that the market has visited once, twice, and now 3 times. And how is the market revisiting it? That's really important. We have the trend, and then each time the market comes back to the level, it happens sooner and sooner. We call this absorption. Every time the market moves away from the level, it is pushed back into the level quicker and quicker. You can see here after the last attempt where the sellers came in, the market immediately ran back into the level. This is a very bullish sign, and it's a good fit into the overall context. Now we can see here, when we just look at the swings, this is what I was referring to. The market is coming back to this sooner and sooner, and also we are seeing higher lows. This is the component of the pressure buildup. A lot of pressure is building here. You get then the breakout. This is then the signal for trend continuations, for trend following traders. Typically they're waiting for breakout entries. Stops are somewhere here below the resistance, sometimes also here below the swing point. And then you have the continuation that trend following traders can capitalize on. Next, volume and price. We're looking for trends, it's pattern based, and we are looking for volume confirmation. I made some recent videos about this way of trading on my YouTube channel. You can check this out. What you want to look for is the overall context. What do we see here? A trending environment. The market has been trending higher and higher. In a trending environment, we want to look for patterns. When we activate the visible range volume profile, what do we see? We see that we have those huge volume drops. We have a significant volume bar here during ranges. And then on the breakout has to be very, very strong. We see that afterwards, after the breakout, the volume drops not completely to zero, but very, very close. There's a huge difference in this volume to this volume. And this is what we want to look for. And we call those zones then supply and demand areas. In the case of a bullish move, we call it a demand area. On a lower time frame, when the price is moving back into this demand area, we can see we have here a pattern, a flag pattern. We want to look for continuations. Remember, we are in an overall bullish environment. So we want to look for pullbacks. We want to look for continuations in the trending direction. So we can use this flag pattern and then look for breakouts. And you can see that this is where the market touched the demand area, and afterwards the trend was continued. So looking for supply and demand areas is also a great way of finding patterns. Next, a wedge. A wedge is a trend reversal, but it's so much more because it helps us understand the overall trending behavior. We look at the buyer and the seller dynamics, and it also uses trend lines. So what do we see here? What is the overall context? And this is the first question you always have to ask yourself. The overall trend context is bearish, right? We're starting here with a very, very bearish market. The market fell in a short amount of time. There was no bullish opposition, right? The market just went lower. And then this is changing here. We are seeing weakness in the lows. We are having also more bullish phases, right? Whereas here there were no bullish phases in the first part. Here we are seeing more bullish phases. And this is a very important market shift. We have the trend line. The market is still making lower highs. As long as the market is not breaking the structure, and as long as the market is not making a higher low, the downtrend is still very much in play, but we are seeing signs that the market is losing strength. Then what we see is that now the market is making a higher high. This is again our breakout, the stop zone here underneath the swing point below the trend line. And then the trend reversal traders are betting on a new trend emerging. And we have seen signs that the trend that has been going on here is losing strength, and you can see the market really shot up higher. Another interesting pattern, the triangle. It's a trend continuation. Again, it has components of a trend, of a breakout buildup, and it uses horizontal levels. What do we see? The overall context is uptrending. The market is in an uptrending mode. We have a very, very strong uptrending market here. The market put in the top, sold off, came back to the top, sold off, but it sold off less. The market moved higher, sold off again less, and we are back here at the level. We have the breakout, very strong breakout. You always want to see strong breakouts. The stronger the breakout, the better it is for the overall pattern quality. And then afterwards, you have your stop zone here. Again, higher lows, higher lows. This is very important. And then we have here the breakout, the retest of the previous highs, and then the market keeps on going higher. We have another triangle pattern where the market is coming from the uptrending phase, moving sideways. We don't see a lot of bearish opposition here, and then on the breakout, the market continues to move higher. And you can see the framework is very similar. You look for, first of all, the overall trending environment. You analyze the pattern. Is the pattern showing you weakness? Is it showing you strength? In which direction is the pattern pushing? And that will help you improve your trading overall and your chart understanding. Let's take a look at the fake out, trap. Some traders may call this a liquidity grab. What we're seeing is we're coming from an uptrend. The market is moving higher. And here we have a long sideways phase. The market has not come into the highest point for a long time. And then here the market gives you the breakout. And immediately we see strong selling. This is the key to this pattern. First of all, we now want to see a long sideways phase where the market is not able to come to the pattern, or to the resistance rather. Then we have the breakout, and then immediately we have the strong sell-off. This is here now a good sign that the market doesn't have the strength to continue the upward cycle. And if we get a breakout here below the lows, that would signal the market is making lower lows, and this could change the trend dynamic. We have the breakout, and then look at this breakout sequence. The breakout sequence shows very, very strong selling. And again, or in the overall context, this makes a lot of sense. We have the breakout that was rejected. We already had a very long uptrending market, so probably some traders were looking maybe for profit taking here. Then you have the shift, and then the market rolls over. So those are really great tips, I think, for your trading overall, because they can help you understand the overall market sentiment. Now let's take a look at a continuation in the form of a flag. So we need to find a trend that has been already moving, and then we look for a flag. So what we have, a downtrend. We are in a downtrend, overall downtrending scenario. And then we have the consolidation here. The market is moving against the ongoing trend that is going down, but it's not moving with a lot of strength, right? It is moving just a little bit higher here in this corridor. And we're able to define the flag using trend lines to both sides. So it looks like a flag pattern, maybe in this case a upside down flag. And what you do is you wait for the breakout. Strong breakouts are again ideal. We have here the failure to take out the highs, the breakout to the downside, and then you can see the trend is continued. So we have the trend, consolidation, very weak phase, and then the continuation once again. Let's conclude with the 1, 2, 3 pattern. This is a little bit more of an advanced pattern, but very, very important. What we see here overall is an uptrending market. In the uptrending market, the market only made higher lows and higher highs, right? So far, until we reach this point, the market never violated the structure. We only made higher highs and higher lows. Now the market is making a lower low. So we call this, in the context of the 1, 2, 3 pattern, the highest point is point 1. Point 2 is the sequence or the end point, where the market is breaking the highest low in an uptrend. So this changes the overall sentiment. And for the 1, 2, 3 pattern, you would look for a retracement back above here, the highest low, and somewhere here below point 1. And this is typically where you then look for your entries. You could, for example, go to a lower time frame. You want to observe what is going on here. We might have here a triple top. We have here the engulfing candle breakout. And this can then used to find continuations in the downtrend that might, in this case it did, occur and emerge. So those are some really great patterns to study for new traders. And in the beginning, I would recommend go for 1 or maybe 2 patterns that you find interesting, study them, backtest them a lot. I will come back to backtest in a moment. And this will help you then over time to get a better understanding of the overall market, of the trending environment, of the pattern itself, and also in which context do patterns work best. So now we have a good idea of what to look for in a good Forex pair. We know what time to trade, and also we have some ideas on some good beginner-friendly trading patterns and strategies. Now let's take a look at the best time frames. And whenever I talk to traders, the question of what is the best time frame always comes up. Let's take a look at the two extremes. We have day trading on the one side and swing trading on the other side. And typically we distinguish between those two broad categories in trading. As a day trader, you're typically on the 3-minute, 5-minute, 15-minute or 30-minute. If you're below the 3-minute, typically we would say this is scalping. So this is very short-term day trading. And what happens is that you have multiple trades per day, because on a 5-minute time frame, you get so many dozens and dozens of candles every day that you will typically go through trending cycles, range cycles, and patterns very, very quickly. However, the requirement is that you need to be very quick at decision making. You have to be very quick on your feet. You have to be also very focused as a day trader, because things can change and happen so fast. So you should eliminate all distractions and you should have a very clear mind when you are day trading. Traders have to be very emotionally stable. If you get maybe 2, 3, 4 trades in a day, and if you have maybe 2, 3 losses in a row, you have to be able to shake this off and still trade at a very high level, not let the emotions get involved, not get emotional when you're making trading decisions. And this is a very, very important requirement of a day trader. News can also make a huge difference when you are on the lower time frames. When a high impact or even a medium impact news comes around, there's a high chance that the market is going to move a lot during, after, or before the news event. And this can really mess up your trades. So as a day trader, you have to be very cautious about the daily news calendar, and you have to always keep an eye on the news calendar. And the benefit of a day trader is that you don't have open night risk or no weekend risk. This means that typically day traders at the end of the day, at the end of a trading week, they close their positions and they go flat. So you don't have to worry when you are sleeping or when you are out on the weekend what is going to happen when the market opens, or in the case of Forex, when the market doesn't close during the week. You don't have to worry about what is happening when you are sleeping. That can be a very big benefit. And typically when it comes to trade or pair selection, as a day trader, typically day traders focus on a few pairs, 1 to 5 pairs. In the beginning, I would recommend maybe 2 or 3 pairs. If you feel that you are overwhelmed by the amount, then observe and analyze fewer pairs. If you feel that you don't get enough trading opportunities and you feel maybe bored, then maybe add another one. Now let's take a look at the other side of the extreme. We have swing trading. And here we are typically on the 4-hour daily weekly. The 1 hour I put in brackets because the 1 hour is not typically seen as a day trading or swing trading. It is definitely not classified as a day trading time frame. So I would put it more into the short-term swing trading category probably. As a swing trader, you have way fewer trades per week, per month as a day trader. Patience is therefore a very, very big factor. So you have to be able to sit aside. Don't trade for maybe extended periods of time. There could be days, there could be even weeks if you're maybe on the daily and the weekly time frame where you don't get a trading opportunity. And also it takes time to get out of a drawdown as a swing trader. If you have 2 or 3 losses in a row and you only get maybe 2 or 3 trades a week, it might take time for you to get back to break even. So although you don't have to be emotionally stable as a day trader, other requirements are coming here into the swing trading. As a swing trader, you typically only focus on high impact news, and the low and medium impact news, they do definitely have an impact on price action, but typically not as much. And especially if you're on the daily and the weekly time frame, short-term volatility is not such a big issue. And because you trade on the higher time frame and you typically hold trades for multiple days, maybe even weeks at the extreme, you do have trades that you have to hold overnight and over weekend. And there are definitely traders who don't feel comfortable with that. I've mentored many traders that said they don't feel comfortable trading or having trades open when they are sleeping or over the weekend. And if this is the case for you, then swing trading might not be an option. Or an alternative might be to significantly reduce the risk. So instead of risking 1%, we're going to risk maybe 0.5% or 0.25%. But I will come back to risk management in a later part. And as a swing trader, you typically follow 10 to 20 or even more Forex pairs. In my watch list, I have more than 30 Forex pairs and markets that I'm following every single day. The reason is that because on any single chart, on any single Forex pair, it will take a lot of time to go through trending and range cycles. You would have to wait for new trading opportunities to emerge for a very long time on one pair. But if you're following different pairs, especially if they're not correlated, you will typically be able to have a very steady or a much steadier flow of trading opportunities than if you would just follow one or two markets. Now let's take a look at risk management. And risk management is often overlooked, but it's so important. This can make or break a trader. Wrong risk management can take a good trading strategy and turn it into a losing one. So here are some tips. And when we talk about risk management, there are two broader categories. I would differentiate between classic position sizing and overall risk management principles. So when we take a look at position sizing, what do we mean? And when we talk about position sizing, what you want to do is you want to have a controlled and a fixed risk per trade. Typically, it's somewhere around 1%. It can definitely be lower as 1% as well. But this is roughly the guideline that you will see in trading books as well, mentioned and recommended. And it's really important that you have a fixed risk per trade. If all of your trades are based on the same premise, then you should also apply the same risk. It doesn't make sense to risk 0.5% on one trade and then 4% on the next trade. You would undervalue specific trades and overvalue other trades. And because you don't know in advance if a trade is going to win or lose, therefore you have to make sure that your risk is stable so that you're betting the same amount on every single trade. When we talk about risk management, you should shoot for a reasonable reward to risk ratio. A lot of traders believe that they have to have very large winning trades in order to make money as a trader. And I will also show you why this is not the case. And you have to be good at cutting your losses. If you have a stop loss, and you should always trade with a stop loss, then you need to make sure that when the price is hitting your stop loss, you don't delay stop loss and you don't delay loss taking. I have seen a lot of traders who, when the price is coming to their stop loss, they will slightly move the stop loss away and away from the price action because they think the price eventually has to turn around and they don't want to realize the loss. But this is a recipe for disaster. So when it comes to position sizing, there are a few very simple principles. First of all, when the price hits your stop loss, you lose your pre-calculated risk and you don't lose more. So if we come back to the 1% position size rule, and assuming you're trading a $10,000 account, whether it's your own or a funded account, 1% from 10,000 is $100. And if you go to Google and you search for position sizing calculators, if you're using MetaTrader, for example, there are lots of automated scripts that can automate this process for you. But there's also things like here, the Baby Pips position sizing calculator. And it's super easy. You put in your account currency, the account balance, the risk per trade, and then you measure for each trade the stop loss distance in pips, and then it will show you exactly you're risking $100, and therefore you have to enter a position with 5 mini lots or 0.5 standard lots. This is a very easy calculation, but you have to make sure that you do this for your trades so that you actually risk the same amount, and therefore you will avoid the crazy swings in your trading account. Now let's take a look at the reward to risk ratio and the win rate. A lot of traders believe that they have to have winning trades that are very, very large, 10 times, 20 times, 30 times their initial risk. And this is absolutely not the case, and it's also very damaging because the wider your target, the higher your potential profit that you're shooting for, the lower the chances that the price will reach it. We have seen it in the beginning when we've taken a look at the volatility and the amount that the Forex pair is moving. So looking at, for example, the Aussie US dollar, it has a daily range and a daily potential of around 73 pips. What you want to do is then stay well below 73 pips on your trade, especially if you're a day trader, because this is the average per day. And typically as a day trader, you don't trade the full day. You typically only trade a few hours per day. So you want to make sure that your trade has a reasonable chance to hit your target, and therefore shooting for very, very wide reward to risk ratios is unrealistic. It is not based in math and statistics, and therefore typically what you will realize is that the market is moving maybe a little bit in your favor, but because your take profit target is so far away, the price has no chance of reaching it. And there's this really interesting connection between your win rate and your reward to risk ratio. And a lot of traders also believe that they have to trade with a win rate of 80, 90, maybe even higher to be a profitable and successful trader. But this is absolutely not the case. Assuming you are able to trade with a 50% win rate, and probably many traders would agree that it would be possible for them to trade with a 40 or 50% win rate if they would abandon the dream or the unrealistic goals of going for 80, 90%. And in the case of a 50% win rate, if you can trade with a 2-to-1 reward to risk ratio, that would be enough to turn you into a profitable trader. That would be enough to put the odds in your favor. With a 40% win rate, a 3-to-1 would be way more than enough to be able to make money long term. So you can see that you don't need a high win rate and you don't need large winners in order to make money. There's a very, very simple mathematical relationship between win rate and reward to risk ratio. The higher your reward to risk ratio, the lower your win rate. And this is so important to realize because this is one of the most common mistakes that a lot of traders make, is when they have those unrealistic expectations of what a trading strategy has to achieve. And now I want to take a look at trading psychology, because psychology is really important in trading and it plays a very, very large role when it comes to becoming a professional, profitable, long-term trader. When we talk about trading psychology, a lot of traders talk about trading emotions: fear, greed, hope, excitement, patience. And I find this a little bit too abstract. So what I would propose, instead of looking at how you feel when you're trading, look at the mistakes that you're making and then try to find out why is this the case. For example, we are starting with the win rate. A lot of traders have the expectation that they don't need to lose or they shouldn't lose. And this is so wrong. There are no perfect trading systems. When you read the market wizards, when you look at the best performing traders, you will typically see that those traders are not near anywhere 100% win rate. Typically, they are somewhere between 40 and 60% when it comes to win rate. So why should the average new inexperienced traders believe that he can trade with a 100% win rate? This is absolutely not the case. And if you have the idea and the goal and the expectation that your trading system shouldn't lose, this will keep you locked in this vicious cycle that a lot of traders are in, where they go from system to system, they try to find the perfect one, but you will find yourself month after or a few years later and you haven't made any progress, you still haven't made any money. And I think this is at the core of many, many trading problems. So the sooner you can realize that, settle for a 50% win rate system, go for a 2-to-1, maybe a 3-to-1 if you find that you're very bold. This is a much, much greater starting point than always abandoning the system. In the first few months of your trading, the slogan and your motto and your theme should be trade to survive. Protect your emotional capital. I've seen a lot of traders give up after a few months because they just can't take it anymore. They keep losing and losing and losing, and then they've had enough. And you need to make sure that you protect your emotional capital. This is done by controlling your risk so that you don't risk more than 1% per trade. And therefore you don't have those big blow-ups. You don't have this gambling mentality. You also play the long game. There you don't look for shortcuts. You don't expect to be getting rich quick soon because this is not going to happen anyway. And you expect and you realize that this is a long-term endeavor. It does take time to become a good trader, and you should look for constant small improvements that you can make week after week. Try to identify one thing at the beginning of every week that you want to do better than you did last week. And if you do this month after month, year after year, you will see huge improvements in your trading. Next, you want to build confidence. And to build confidence, you need to put in the effort, you need to put in the time, and you need to do the work that is necessary. You need to backtest a lot. You take one of the trading strategies that I've presented in this video, or you can choose from the wide variety of my YouTube videos that I've made in the past. You backtest them, you gather statistics, you see how they would have performed, you find the right Forex pair based on where you are located and based on your time availability. You put in all of the trades in your trading journal, hopefully it's edgewonk. Then you analyze it, you review it, you adjust where you find weaknesses in your system, where you see that things are not going as well, are not going as according to the plan, so that you can improve on your weaknesses. You look also for things that are already going very well, so that you can then do more of that. And that way you build over time a much more solid approach. And this is also giving you the confidence because you know the numbers, you've put in the time, and you know what to expect. And this is such a big help. And also consistency. You want to get into a consistent trading behavior, trading approach. You don't change your strategy just because you have maybe 2, 3, 4, 5 losses. The strategy necessarily doesn't have to be bad. What I would recommend is that you look at your losses that you have realized and you ask yourself for every single loss, was this really the fault of my strategy? Or maybe did I break my rules? I did something that wasn't according to the rules. I overlooked something. And what you will see in most of the cases is that you are probably the one that made a mistake and it's not your strategy to blame. And then you realize that it is not the strategy that needs to change, it's you that need to change. Also in the beginning, you pick one strategy, you pick maybe 2, you don't have 5 or 6 different patterns or strategies that you're trading. You really try to specialize in learning and improving the patterns. You look at the context, when, how, where is it happening. You have a regular routine. When do you backtest? When do you do your trading plans? When do you prepare? When do you journal your trades? You have consistency in your risk management, so every trade has the same weight. And again, you look for small, constant improvements. You don't try to change everything at once. You try to find one thing every week that you want to do better than the week before that. And if you keep doing this, if you keep stacking the improvements, you will see progress, and this is inevitable. And if you want to take your Forex trading to the next level, then I have the perfect program. I call it the Tradecademy. This is my new trading program. It is the ultimate all-in-one trading education program. When I created the Tradecademy, I asked myself, what would have been the ideal trading program that I would like to have had when I started trading 17 years ago? So I created a brand new trading course. You get mentored by me, there are live webinars, and there's a private community where you can chat with me every single day. You can ask me your questions every single day, and I will provide answers. I don't use any other coaches, I don't use any other traders. You're always interacting with me directly. I have a lot of trading strategies that are waiting for you in the Tradecademy. I have never shared the strategies and the videos anywhere else before. They are working for swing trading, for day trading, and pretty much I'm covering all of the time frames. You join the private community, and we've also seen great success in the traders that have joined. We trade Forex, but if you are not trading Forex, you can also use the Tradecademy if you're trading commodities, crypto, or even indices and stocks. I also upload a new video every single week where I break down the Forex market. I help you to analyze the Forex market. I show you what are the most interesting setups, what are the most interesting Forex pairs, what are the best levels to trade. In my live videos, you can interact with me. I show you my charts, you can ask me questions, and you have a very direct contact and a very direct way of interacting with me. If you want to see the full course syllabus, you can also go here and you will see the 9 modules that are waiting for you. Again, over 80 videos, and I'm providing new videos pretty regularly. There's also a special discount waiting for you, so if you act fast, then you will also be able to save on our current offer. If you have questions, let me know, and I will look forward to meeting you in the Tradecademy.